Hi, good morning. This is Dan Moorhead from Pantera. I have my partners, Joey Krug and Paul Radhatakit here with me, along with some of the other investment team members. And the purpose of the call is to give a bit of a background on Pantera Capital, our perspective on the opportunity here, and then explain two of our funds, the ICO and Digital Asset Fund. We also have venture funds and Bitcoin trackers. And for many of you, you're been investors in Pantera for years, but I know quite a number of you, this is your first call or your first introduction to the firm, so I wanted to give a bit of a background on the firm. I started as a CMO trader at Goldman Sachs in the 80s, and then transitioned into being a global macro style hedge fund manager. Ultimately went to work with Julian Robertson at Tiger Management, where as the head of macro trading and also the CFO. So my day job over these past 30 years has been to trade big picture market movements in currencies, bonds, equity indices, things like that. But my passion's always been investing in disruptions, all the way back to the Russian privatizations in the 90s and leading up through Tesla Motors 6 or 8 years ago. And when I got introduced to Bitcoin in 2011, it took me a while to get my head around it, but I ultimately came to believe that it's going to be the biggest disruption of this generation. And so I wanted to, essentially go all in. And so Pantera completely refocused on blockchain in early 2013. And by July of that year, we launched the first cryptocurrency fund in the US. And that fund is still actually relevant. When we were trying to figure out how to help others get exposure to Bitcoin, we looked at ETFs and all kinds of other structures, but decided to pick hedge fund structure because it's obviously much easier with the SEC. And we made a few important modifications. We made it a daily liquidity fund, so that made it very easy to get into and out of, but did set it up officially as a hedge fund. And I was just on CNBC a couple days ago, and they're talking about how the Bitcoin ETF is still not approved, and that's been 5 years. I think it's still going to be quite a while. We're going to go through a couple of big picture thoughts on what the opportunity is. You're welcome to start asking questions in the Zoom chat box. Lauren and Joey and Paul will be answering them live as we go. And then at the end of this, we're happy to stay on and answer as many questions as you all have. So if you have to head on to your next meeting, feel free to hop off, but the investment team will stay as long as it takes to answer all the questions. So our team is split up San Francisco, Sand Hill Road, and New York. We have most of the investment team in San Francisco. My partner, Joey Krug, is the co-founder and core developer of Augur, which is an absolutely fascinating project that just went live about a month ago on Ethereum. It's already one of the top use cases of cryptocurrency. He is my co-CIO, and then Paul Radhatakit and I have been partnered for 5 years in sourcing venture deals and ICOs. And the way I like to think about it is blockchains are essentially the next step in the evolution of currency, or in this case, equity. And Bitcoin, Ripple, Zcash blockchains like that are essentially a better form of currency. So they replace the crappy paper currencies that we're used to. And then the dApps built on top of blockchains, so ERC20 tokens and the like, are essentially like digital companies. And there's obviously some really important distinctions between securities and protocol tokens and things like that that I won't have to dive down into. But it's the way to think about it, that you often hear that the ICO market is obviously overpriced because there was 57 ICOs last week, but there's 4,500 public companies in the United States. We could have thousands and thousands of protocol tokens built on top of blockchains. And there's so many different ways to understand blockchain. And I often hear potential investors say, oh, I just don't understand Bitcoin, or I don't understand this and that. And the way to think about it is, I don't totally understand how jet airplanes work, but I know they're much more efficient than walking to New York. And so it's not necessary to actually understand every single thing that underlies a Bitcoin or Ethereum or whatever. But having some perspectives on why it's going to be important is useful. And one of the perspectives would be that it's the final piece of the protocol puzzle that is the internet. And if you think about it, the internet's just a bunch of protocols for moving all kinds of data around. Some of them existed since the 70s, and it took 40 years to get around to a money protocol, but that's basically what Bitcoin and other blockchains are. It's a protocol for moving money around without paying a very expensive third party. And speaking of expensive third parties, it is very much like what VoIP did to the telephone market. Back in the day, you used to have a monopolist, AT&T here in the United States, a copper wire across the Atlantic, and then another monopolist, British Telecom, on the other end of it. Phone calls were very expensive, and the quality is pretty crappy. When we realized you could route voice over the internet, the cost of calling went down more than 2 orders of magnitude. So it's less than 1% of the cost 25 years ago. The quality went way up, and the quantity is so astronomically large now that we literally don't have enough copper on Earth to run the internet. So I think it's a perfect analog to what Bitcoin really is money over internet protocol. We're going to be able to route money around the legacy monopolists that control each of the payment rails. And if you think about it, there really are very, very concentrated owners of each of these payment rails. Western Union is a 140-year-old monopoly that controls remittance, charges an entire month's wages to migrants to have the ability to send money back home to their families. There's another 140-year-old duopolist, American Express, that controls credit card swipes. And if you think about that, prices of everything have crashed over the last 45 years, but the price of swiping a credit card has never changed. So there's obviously something strange going on there. And then you have about a dozen correspondent banks that control all cross-border money movement and make it very, very expensive, very opaque, and takes quite a long time. So when you have a disruptive technology, they call it a category killer. Bitcoin's a serial killer. And I say that for 2 reasons. One is it is going to go after dozens of different markets, not just the credit card, not just remittance, not just gold storage. It's going to go after dozens and dozens of different use cases. But the other reason I really think it's important to call it a serial killer is to remind people it will do it serially. It's not going to do everything overnight. And just like the internet didn't do everything overnight, like in the early 90s, the internet sucked. It really didn't do anything. And now you have, Uber and Snap and all these really cool applications, right? It took decades. The same thing with blockchain. It's going to take decades to roll out all of the important use cases. And this slide is just to remind people that blockchains are essentially supersets of all the existing payment rails and money storage systems. They can do everything that gold can do, that electronic money can do, or paper money can do, and all the different payment systems. And again, it might take 10 or 20 years for all this to play out, but that is why I'm very excited. And I think this trade is so strong, because even if a couple of our use cases that we're excited about ultimately fail, this is still going to be an incredibly strong trade. And the reason we've gone essentially all in on blockchain is it's the most asymmetric risk reward trade I've ever seen in my life. That if you invest in it, I used to always say you could lose all your money. These days, actually, I think if you have a portfolio of secure or assets like in any one or several of our funds, you really can't lose all your money. But let's just say in the extreme, you could lose 100% of your money. The upside is an order of magnitude or more. I think many of these funds can go up 25x, and that's just not something you can see in any normal investment opportunity. And anytime you have something that can go up 25x, it can only go down 1x. It only has to have a 4% chance of working for you to want to invest in that. And I actually think it's like a 50-50 chance that these things go up that much. And just to kind of highlight, how the market is changing and could keep changing, here's the several orders of magnitude we've already seen in our fund management history. We launched when Bitcoins were at $65. They're now 2 orders of magnitude higher than that. I think you can go another, at least 1 order of magnitude, and potentially 2 over the next decade or so. And then the original world was very easy. There was just Bitcoin, nothing else to invest in. And there was no equities, there were no other currencies, there were no tokens built on top of other currencies. And now it's a much more interesting world. There's 1,500 projects out there. We're seeing projects all the time. And so it is necessary to have a diversified portfolio. There are a subset of people called Bitcoin maximalists that believe that Bitcoin is the one and only true heaven, and that is where you should have all of your exposure. I think that's kind of like in the 90s being a Yahoo maximalist. Yeah, Yahoo was a really cool company, but there were dozens of other interesting projects as well. And that's how I think investors should view the crypto space. In our ICO fund, digital asset fund, and venture funds, we typically own about 30 different assets in each of those funds. So the combined package has the better part of 100 assets. And I actually think that's the most sensible way to invest, is to get exposure to a very wide array of types of assets, tokens, equity, mega caps like Bitcoin and Ethereum, small pre-auction ICO contracts. And when this big disruption happens over the next couple decades, that portfolio will probably have performed well. And the last big thought to share is, I think we're really heading towards a post-capitalist era where in capitalism, it's a wealthy individual who invests money to bring gain. And here in the last 30 years, we've had a kind of interregnum period where Bill Gates and Sergey Brin and all these people, they're not capitalists. They were college dropouts that were dead broke when they started their company, creating technologies that were very valuable. Now we're going to have cooperatively owned technologies that are very valuable. And so you have projects like the Ken ecosystem being built on Kik, which is going to be a social network very much like Facebook, but very different in that one single person won't have total control over the company. It will be community owned, and all the contributors will share in the success and the governance of the project. And with that, I'm going to give it over to Joey Krug to give a bit of his background and explain his views on protocol tokens.
Thanks, Dan. So one thing that's different than what you saw with the internet is that in the internet, almost all the value kind of went to the applications. And the reason was because that's where you could have a proprietary edge. And that's where you could create value. The protocols were open source and they didn't do anything from a monetary standpoint. In the blockchain space, one thing that's a bit different is most of the applications, with the exceptions of things like fiat on-ramps, most of the applications are forced to be open source as well. And the reason is, since they're dealing with your money, and cryptocurrency is kind of like a bearer bond, in the sense that if you have it with you and you use it in an application, that application can steal it unless you can tell if the application's being honest. And the only way to really tell that is if the application is open source. So what that ends up meaning is that for the application layer in the crypto space, most of those applications are completely open source. So it's a lot harder to monetize the application layer. And then if you look at kind of the whole thesis behind the crypto ecosystem in general, a lot of it's based on disintermediation and getting rid of unnecessary middlemen. And so if you look at the sort of things that people are kind of willing to pay for, what they have to pay for, the number one thing there is really security. So in Bitcoin, you're paying for the security that, if you send someone 1 Bitcoin, they actually receive 1 Bitcoin, and that you can't spend the same Bitcoin twice. In Ethereum, you're doing the same thing, but it's for kind of more generalized computations. And even things on top of these protocols, things like Augur, it's a similar story. For Augur, the thing that you're paying for is the kind of knowing that your bet will basically be resolved correctly. And so for that reason, the protocols have something that value kind of has to accrue to them if this space ends up working out, because you have to secure these networks versus the application layer is all open source. So it's a lot harder to monetize. And so if we go to the next slide, we can see empirically that most value in the space has gone to the protocol layer. Even if you account for the massive kind of downturn right now, it's still about 90-10 on protocol versus application layer value accrual. And so if you look at kind of what each of Bitcoin and Ethereum brought, if you look at Bitcoin, the main thing it really kind of gave the world is the ability to transmit value in a way where you don't have to trust anyone to be able to send value. The main kind of limitation of Bitcoin, though, is that you can't really do anything else with that value. So if I want to send you, $1,000 in Bitcoin, that's pretty easy. I can do that. If I want to place a bet with you with $5,000 in Bitcoin, or I want to enter into a derivative contract or a swap agreement, or if I want to, participate in a file storage marketplace or a computational power marketplace, anything like that, you can't really do with Bitcoin without trusting some central intermediary, which basically defeats the purpose. And so if you look at Ethereum, it enables all those sorts of marketplace transactions, because basically what you can do is you can send your funds to a computer program called a smart contract. And that contract can then process your bet or your order in a marketplace or whatever it may be. Over the past year, people have used Ethereum quite a bit for just running ICOs and initial coin offerings. But I think that over time, the full vision of Ethereum is quite a bit different. And if you look at decentralized applications in general, there's kind of a whole swath of verticals that can go after. Anything from sharing economy style things like Uber and Airbnb. If you look at that space, Airbnb is much lower hanging fruit because blockchains today don't scale. So there's not a lot of transactional throughput that you can take advantage of. But if you're renting a house on Airbnb, you don't need to do that frequently. So the scale limitations work, even today. Besides that, online gaming is a pretty big use case, or we think it will be. If you look at the internet, one of the first applications of it was gambling. And it's a classic space where there's either middlemen who charge a lot of fees, or you have a lot of trust issues. The site that operates your online poker site can be, looking at the cards and cheating, which has happened in the real world. They can be shut down, or they can just run away with your money, all of which have happened. And with this tech, you can prevent that risk. And then the last kind of category are things that more fit into marketplaces like storage marketplaces, video streaming, things like that, where today it costs a lot because you have to pay for a lot of computational power or a lot of storage capacity. And those are run by mostly software organizations who charge software level margins. And if you made it a more open free market, you would see things drop down to kind of more closer to the marginal cost of hardware. So if you had a say decentralized version of AWS, the cost would be substantially cheaper. And so if you look at the role of ICOs in the space, the main thing that they're really useful for is if you're creating some sort of protocol, it makes a lot more sense to have something that anyone can kind of easily buy in and out of, and that's a liquid asset, unlike traditional equity where you're locked up and you can't really use it for a whole lot. Versus tokens, you can use them in things like staking mechanisms. You can use them to buy and sell things, and it's a lot more of a fluid sort of asset. And so if you look at ICOs and compare them to kind of the IPO boom in the 90s, if you had a portfolio of things, turned out pretty well in the long run. But if you just bought one or two things, that could either have been very well or very bad. And so we think of ICOs in a similar light. So if you look at the ICO fund, it owns around 35 to 40 positions at any given point in time. And the reason for that is we think a diversified portfolio is kind of the key to doing well in the space in the long term. Because I think similar to venture, ICOs are going to follow a similar power law distribution where 90% of the returns come from 10% of the deals. And so the overall approach for the ICO fund is basically look at these projects from a kind of fundamental level, see whether the tech makes sense, whether the economics make sense, how strong the team is, what sort of market they're going after, look at the product, things like that, and then make decisions on a kind of fundamental level. And the thesis for it is basically that for any of these sort of multi-sided marketplaces or protocols, we think ICOs are kind of the future of the funding model for that. And from Pantera's perspective, we're a strategic investor. We invest, usually in the very first round that these projects raise, and help them, find other investors, help them on the tech side of things, introduce them to anybody they need to know, things like that. And so that's basically our investment strategy. So we go after these projects really early on, help them kind of get things off the ground, answer any questions they have, help give them any sort of advice they need. At Pantera, we have Paul, who's been in the space for a long time and knows pretty much everyone. Myself, I've done the first ICO on Ethereum and shipped a live product on there. So we can help them with kind of the unique challenges of building on a stack that's just super nascent. If you think of this space, it's kind of like building on the internet in 1992. There's a lot of stuff that isn't common knowledge just because of the fact that it's so new and so nascent. And this is an overview of kind of the things in our portfolio currently. Basically, you have infrastructure level things, so like scalability projects, some decentralized exchanges, a lot of things in this slide that kind of fall in the category of disintermediating certain marketplaces. And then the last big category that we're super bullish on is decentralized gaming, decentralized casinos, decentralized poker, things like that. Mostly because they're lower hanging fruit use cases that are kind of going to be some of the first ones that I think will actually take off in a space where the tech's kind of so hard to use and so new. And an update on a few of the projects in our portfolio. Thunder, which is the first investment we made in an Ethereum competitor, has a live test network now, so you can test things on it. At Augur, they tried running things on the Thunder testnet, and for comparison, on Ethereum, you can do about 1 trade every 2 seconds on Augur. On Thunder, you can do about 200 trades per second. So it's a large improvement in throughput and scalability. And the team is really sound team who has a really good academic background in the space. 2 other projects is Mycenos did their first artwork auction on Ethereum. They're basically trying to disintermediate the auction houses. And then Doc.ai partnered with Anthem to do a 12-month clinical trial on allergies, trying to see if basically machine learning improves patient outcomes there. And so for assets that are in kind of the more public liquid markets, we have the digital asset fund. And so it only buys things that are kind of already publicly traded in the space. And it's a kind of diversified multi-strategy approach. And basically the thesis there is very similar to the ICO fund. We're looking to capture value of what we think are the best protocols built on these networks. And also do some quantitative analysis for determining kind of which assets to buy and sell. And I think that in the cryptocurrency space, holding kind of a diversified basket of assets is a better approach than just buying Bitcoin and Ethereum. Because if you look at kind of the space, I think in the future, a lot of the returns are going to come from things that are kind of more smaller caps and not just the top 2. There's a lot of interesting stuff in the space besides just Bitcoin and even Ethereum at this point. And so two updates on the digital asset fund is that we're also doing discretionary trading, taking special kind of situations plays. So things like, investing in Maker because we're super bullish on it. Investing in Rep after the launch, things like that. And then also we've working on automating a lot of the trade execution now. So even right now, some of the new orders that we're putting on are being executed algorithmically as opposed to manually, which should improve transaction costs, slippage and market impact. And this is a chart of the performance since inception. So since December, it's basically flat relative to Bitcoin. And in terms of things that have happened in the space recently, one milestone is the launch of Augur, which came out July 9th. After about 3 years of development. First had an alpha in 2015, and then in 2016 a beta, and in 2017 they found a bunch of vulnerabilities in one of the languages on top of Ethereum, and so I had to rewrite everything into a different programming language, and then shipped July this year. And somebody asked a question in the chat that's kind of relevant to this slide, so I'll just answer it with this one. Somebody said that stuff like Augur is interesting and cool use case, but how do Augur and other dApps plan on driving users to the application? All applications have customer acquisition costs and problems. And I think if you look at something like Augur, it's a good case study to use for how do you draw people to use a decentralized app. And if you look at Augur right now, it economically does not make sense to use it. And that's something that kind of we always knew would be the case when it first launched. And the reason is you have problems like Ether's daily volatility is 5%. So if you enter into a bet with someone and ETH happens to go down 5%, well, if your edge was 4%, if you have an alpha of 4% over the market, well, you just lost your money even though you were right. So that's one problem. Then you have fees of getting into crypto. So like the fiat on-ramp problem. Coinbase charges 4% for debit cards, 1.5% for ACH. We invested in Bakkt recently, which is the spin out of the New York Stock Exchange. And so, hopefully that will help drive the cost down for getting into crypto. And then you also just have the fees of using something like Ethereum. So if you look at, Ethereum right now, and look at the kind of gas cost, because it doesn't scale, the fees as a percentage of an average transaction that you do on, say, something like Augur are about 3 to 4%. So if you add all those fees up, you end up paying, 12% in fees for any given bet that you make on Augur. And so that means the payout ratio is worse than a site like, say, Betfair or Bet365 or Paddy Power or whoever it may be in the regular world. And so for something like Augur to gain users, and all these sorts of fee problems apply to pretty much every dApp in the Ethereum ecosystem, by the way. Something like that to gain users, the cost needs to go down quite a bit. And so things like implementing DAI as a stablecoin, things like better fiat on-ramps like Bakkt, things like scaling Ethereum, all those things can help drive the cost of using it down. And so if you look at something like Augur and then you look at the user acquisition problem, you don't really want to start even attempting to get people using it until it makes economic sense to do so. Otherwise, they're just going to use it and be upset because it's so expensive. And so once the payout ratio for something like Augur is, say, 95% or greater, which compared to Betfair and Bet365 is about 92%. Once the payout ratio is better than that, then you can start kind of spreading the word about it more and getting people on board and using it. And at that point, it makes financial sense to use it. Eventually, I think the payout ratio will be something like 99% or 99.5%. And if you compare that to a regular betting site, there's just no contest. If you're a trader or a market maker on a site like that, and you're paying 8% in fees, and you can use another platform where you pay 50 basis points, you're going to switch to the other platform.
Hi, this is Paul. I'll talk a little bit about institutional custodians. We believe that institutional capital is on its way, and one of the things that's sort of gating that is having reputable institutional custodians in the ecosystem. And, Goldman Sachs has mentioned that they are looking to provide some sort of custody solution sometime in the future. And I think that's still a bit away, but it's a good sign that they're thinking about things, and they're also principally investing into a bunch of companies right now. Some of them are portfolio companies, so they are getting very active in this space. Coinbase recently launched a custody service for institutional clients on July 2nd. We've talked to them, and they're going to be a qualified custodian. I think they're going to be a pretty big player in that in this ecosystem on that. And then Northern Trust, which is a pretty well-known and trusted custody solution, has also mentioned that they are looking to provide custody for crypto. We also see internationally other types of institutions looking to provide crypto. Nomura Investment Bank in Japan has also mentioned that they will look to custody crypto. And, we think that, at the end of the day, all of these solutions are going to hopefully have really strong technology, but it's a business development play too. And, we see custody solutions emerging in all different geographies, and almost like how exchanges sort of, emerged all across the world. We see custody solutions doing the same thing. We also see custody solutions targeting not only institutional, but also retail custody. And I think that's also going to bring more mainstream users into this space.
Hi, this is Lauren. So earlier this month, ICE, the parent company of the NYSE, announced that it was creating a company called Bakkt. Bakkt has 3 core products. They offer an exchange, they are offering custody solutions, and they're also offering a payment system. And Pantera has been working really closely with them, giving them feedback on the design of their platform. We are just really excited about this technology. It's yet another piece of robust infrastructure that we believe is really going to drive mainstream investors into this space.
And lastly, in terms of regulations, I think that's what is going to be sort of the only thing that is really going to affect really large movements in the market. And I think for Pantera, we've done what we can to sort of make sure that we are doing things the right way in case all of these tokens get sort of marked as securities. We're registered as an investment advisor by the SEC, and I think that shows that we have a commitment to sort of working with U.S. regulations and really kind of staying ahead of the game on that. The NYDS has also granted a wave of bit licenses, and Zappa, one of our companies, was also granted a bit license. Circle was already granted a bit license. And so, we think that there's some movement there to get New York involved. We've seen some ICOs recently that have blocked New York. So I think, there's progress made in that geography. And then also the Swiss Stock Exchange is launching its own crypto exchange, and the platform will offer trading, settlement, and custody solutions. And, we think that is a pretty big development. Also, we've seen quite a few of our companies looking at places like Luxembourg, which has been very sort of open about being a hub for crypto companies to sort of work with their country and also sort of gain regulatory approval across Europe. In addition to that, a lot of exchanges are looking at Malta as a place to set up an entity, just because Malta has sort of been sort of at the forefront of trying to be innovative and bring crypto companies there and sort of give them liberty to have banking relationships, etc. Malta has gotten Binance sort of involved in their process of building an ecosystem over there and has gotten some notoriety. And then one more geography recently, I was on a panel with Vitalik and we were talking about regulations, and moderating that panel was a guy named Jason Shu, who's a legislator in Taiwan. And Jason is really pushing towards Taiwan being a hub for all of blockchain in Asia. In addition to being able to have banking relationships in Taiwan, they're also building a huge co-working space of that'll house over 100 companies. And the government, based on sort of criteria that they'll come up with, will actually match funding for any blockchain startup that has a presence in Taiwan. I think they're gonna invest 1.5 times whatever outside capital that company gets. So for instance, if a company received $100,000, Taiwan government would give them an extra $150,000 Taiwanese dollars. So we think that Taiwan is a potential good haven for regulations.
Hey, this is Dan. I'd like to wrap up with just a few big picture thoughts about timing. And obviously the markets are fun because everyone has a different opinion, and there's a lot of greed and fear pulsing through the markets. For whatever reason, cryptocurrency is more exacerbated, and the evidence in our 5 years of managing money here is that even our investors, who are incredibly sophisticated in ourselves, are just like other humans and very pro-cyclical and really want to pile in when the market's surging and at its peak, and then when it's not, often kind of let it drift. And this is the 2 histograms of the actual inflows into Pantera Bitcoin Fund. And you could see that the amount of time that the price of Bitcoin stayed in each of these buckets, which is represented in gold, was fairly normally distributed, a nice bell curve. But the percentage of our subscriptions into the fund were massively skewed to the upside, that when the price was quite low, no one really cared. And then as Bitcoin went over $500, it started becoming disproportionately interested. And then at 1,000, tons of people piled in. And that was in the 2013-14 era. And then the same thing has actually happened in the second era, where over the last 2 years, Bitcoin has spent over half of its time below $1,000, but very few investors were interested. And then as it got up to the 1,000 to 5,000 bucket, it was pretty much market neutral interest. And then when it went above 5,000, there was a ton of interest. And so we would just want to highlight that, when the markets come down 65% like they have, that's actually a really good time to either initiate or increase your position if you have the financial and emotional resources to be able to do it. And to put in perspective, here is the price of Bitcoin graphed exponentially, and it's actually incredibly stable. It's been growing at a very, very constant compound annual growth rate since its beginning. And if Bitcoin were to return to its trend by the end of this year, it'd be at 21,000. And then at the end of next year, it'd be at 67,000. And we typically don't make any kind of short-term predictions on the price. This recommendation to buy that we made at 6,500 in February and then in April again, and reiterating it now, is only our 3rd trading recommendation in 7 years. My normal view is just this: it's going to return to its trend. And so if you're looking for just even a concept of where we could be going, this is what it looks like going forward. And then just a funny one to end on, everyone was talking a couple of months ago about Warren Buffett calling Bitcoin rat poison. It is rat poison. It's just the banks and credit card companies are the rats. And if it takes Berkshire as quick to buy Bitcoin as they bought Apple, they would be buying Bitcoin in 2043. So to summarize, here's an overview of our programs. We have the passive Bitcoin tracker. It's a daily liquidity hedge fund. People often ask, well, why would I pay you to do that when I can do it myself? Our fees have for 5 years been by far the lowest in the industry. We just charge 75 basis points management fee and no performance fees. So As Joey mentioned, going in and out of Coinbase, it's 1.5% for ACH plus the bid offer spread plus, 25 basis points or whatever commission you're paying. So it's actually quite expensive to do it yourself. Our fund guarantees mid-market execution on any US banking day, which is actually super important when the markets are very stressed. I get tons of emails and phone calls with people saying, hey, my money's stuck in Kraken or my money's stuck in Coinbase, can you help me? And in our case, we guarantee any US banking day you'll get out at mid-market. And then our two hedge funds we've been talking about, Digital Asset Fund and ICO Fund, they're both quarterly liquidity, and none of our funds have any lockup. So you can come into the fund and go back out 90 days later if you don't like it. The one important note to make here is we do have different funds for onshore US investors versus offshore non-US, non-taxable investors. There is a law in the United States that if a US-based manager manages money for foreigners, they have to collect 32% withholding. Most of us are not familiar with that law because there's an exemption in the statute if it's trading securities, currencies, and commodities. And that's what 99% of normal hedge funds do. So we're never thinking about that. But there isn't an exemption for cryptocurrencies or protocol tokens or whatever you want to call Bitcoin and Ethereum and things like that. So many of our competitors do manage money for foreigners, commingled in the same fund with domestic investors. We think that's extremely risky, that if the IRS were to pursue them, the tax burden is first put to the foreigner, but the foreigner's probably going to say, hey, I redeemed 3 years ago, I'm not paying. And then it goes down to the domestic LPs. So, and the US government is very good at compelling US citizens to pay tax obligations. So that is why we have separate funds. We have an offshore version of the ICO fund, which is called the long-term ICO fund, and it holds positions for at least 1 year so that it is exempt from the trade or business criterion in the US tax law. And then the digital asset fund, since it is very actively traded and can't hold things for a long period of time, is unfortunately unavailable to offshore accounts. And then we have done 3 venture funds. Our first fund was in 2013. We invested in the ways to acquire and store Bitcoin like Bitstamp and Zoppo, and then transformative companies / protocols like Ripple. Our second venture fund was 2015, and we invested in about 25 companies that do all kinds of things. About half of them are involved in cross-border money movement, and then the other half are a really interesting mix of other use cases. We're now raising our third fund. It's a target of 175 million. We announced it a few months ago and raised 100 million in a relatively quick close in June so that we could invest in Bakkt and other really strong deals we have in the pipeline. We'll have our final closing somewhere around the end of the year, and we'll begin deploying that. And investors that invest in the fund now get exposure to all the deals that are already in the portfolio. And if an investor invests 5 million or more, they can be in the co-investment class and would be able to invest in the co-investments from here to there. And then if an investor comes in at the end of the year, they would get all of the positions, but potentially they might have been marked up by then if something happens. And here's just an overview of our funds. We'll now take questions. Many of the questions we've been answering as we go. If you want to ask it verbally, just go ahead and unmute yourself and ask aloud, or you can ask in the chat box if you want. Oh, and while you're thinking of questions, a few housekeeping issues. If you are interested in investing in the digital asset fund or the ICO fund, those funds have monthly subscriptions, so you can come in at the end of any month, and then you can come out at the end of any quarter. And as I mentioned, there's no lockups in any of our funds, so you can come in very briefly if you want. And on the ICO fund, because these things are not yet traded in a liquid market, many of the pre-auction or the pre-auction ICOs, those are held at cost until they begin trading and that we could realize the profits. And then if you have questions that occur to you after the call, you can reach our investor relations department via ir@panteracapital.com. Oh, and just wanted to go further into the ICO fund marking policy. We are buying into pre-auction projects. They're kind of like pre-IPOs that take 3, 4, 5, 6 months to go live. Some of our competitors mark those prices up to the quote futures price, but those markets are incredibly thin and incredibly easy to manipulate, and then certainly not liquid enough to actually realize the profits. So we hold positions that are not yet trading at cost. About, well, 47% of the portfolio is marked at cost. So there are probably some embedded gains in that portfolio. If you become an LP and you invest, you'll get your pro rata share of those gains. If you leave in 90 days, you'll probably only realize a fraction of those. If you stay invested in the fund for years, you'll realize almost all of them. So it's really, it's the only way to do it in an ethical, fair way. And it does incentivize investors to stick around longer if they want to realize more of those gains. And also, Paul had mentioned that we've been very proactive with the government. Pantera used to be a registered investment advisor with the SEC when we were managing $1 billion of very complicated stuff. When we started managing cryptocurrency funds, since none of the assets that we own have ever been deemed securities, we were an exempt reporting advisor for a number of years. But at the beginning of this year, when the SEC started kicking up more rhetoric about cryptocurrencies and in particular ICOs, we made the very proactive step to restructure our ICO fund from just a partnership that didn't have to comply with the Companies Act to one that was split into a 3C7 and a 3C1 fund. And then we registered with the SEC as well. So we're trying to dot every I and cross every T. That does give us several different versions of the fund, and each one has different minimums. But we're trying to keep the minimums very accessible. We realize that this is a very interesting new asset class, and that some big organizations don't yet have approval. So we want to make sure that principals can invest their personal money in the funds. Our typical minimum is $100,000 to allow people to get invested. Some of the funds have minimums a bit higher, up to $250,000. So if you are interested in the minimum is important, please get in touch with our IR department to figure out which minimum is appropriate. All right, there's a fascinating question about these new disruptive companies like Kik taking on the monopolists like Facebook. And then what's going to happen when they move to adopt cryptocurrency or whatever to compete? That's just, it's a classic question for legacy monopolists, right? It's like the golden goose is laying some incredibly valuable eggs. When do you want to sacrifice that golden goose in order to be part of the future? And there are classic examples like Kodak Film, who actually had a functioning digital camera in 1979, ending up going bankrupt because they just couldn't make that decision. I don't see the Facebooks and the Googles ever wanting to go to a decentralized future, right? They make a ton of money by being centralized monopolists. Google and Facebook get 99% of the marginal online ad spend. They have no incentive to change the status quo. So it really does take a scrappy outsider like Kik or Brave Browser, to come at these monopolists. And it's David and Goliath stuff, right? I mean, it's not like Kik is going to slay Facebook anytime soon. But over the next 10 years, I think they're going to make good inroads. And I think the Kik trade is a good example of the asymmetry I was pointing out. Is they had a company valued $1 billion, and they sold their tokens at $1 billion, and $1 billion valuation. And then they were essentially pushing that $1 billion chip out on the poker table against Facebook at $450 and all the other social media companies at probably $1 trillion in value. And it's more than a 1 in 1,000 shot they win. that kick and can win. So, that's how I view these trades, is that the odds of these companies being disruptive are much higher than the way they're being priced. Oh, and the question about the presentation, yes, after the call, we'll send out the presentation itself, and then also a transcript in case anyone wants to, just hone in on a specific issue or not. And then I presume all of you are already on our investor letter list, but to the extent you have friends that have joined the call, or somebody that's not yet on, we're really we've for 5 years been very committed to try and evangelize this new asset class, and so we're very transparent and issue a investor letter once a month that has 8 or 10 pages of our thoughts on the industry, and then very importantly has links to really effective either podcasts or books or articles or whatever in the back to help people get educated. And you're more than welcome to share that with your friends and colleagues, because we're really trying to help educate the entire space. The performance of the digital asset fund has been essentially in line with the market for the month of August. It's down 21% right now. And my thought on the market overall is we definitely have gone through 7 bear markets like this in the history of Bitcoin. The average downdraft's been 65%. We've had a 68 or 70% downdraft. I think that it certainly could be there certainly could be short-term fluctuations, but I think this downdraft is probably as much as you're going to see. And so if you said, hey, looking out 6 to 12 months, I think it's massively higher than a 50-50 chance the market will be higher in 6 to 12 months than it is today. And my view is around here, or in the 6,000s is appropriate bottom. And I said that in February and then again in April, and it's essentially bounced off that 3 or 4 times. So, I think that will be, it's highly likely to be the low point for the industry. And I think we've answered all the questions that are in the chat box. If we missed any one of your questions, we'll please shoot it in again. But if not, just want to remind you, if you have a question that comes to you after this, go ahead and send it to ir@panteracapital.com. We'd be happy to answer it. Thank you all so much for joining the call.